Thank you very much, Surabhi, for that. And it's great to be here. It's great to see all of you. Really sort of wonderful seeing so many familiar faces. And of course, it's a very special event for us, launch of the CNBC-TV18 PRIME Circle. And, you know, the topic, as Surabhi described, can real assets outpace equities? Many of you would be wondering, why do we have Mr. Raamdeo Agrawal on the panel? And let me just, let me explain why I'm saying that. Raamdeo ji is, of course, as many describe, the Warren Buffett of India. He's built the equity culture, and, you know, I'm not overplaying it, it's absolutely correct. I mean, you know, you think equity, I think one of the people you think is Raamdeo Agrawal, and he's had a huge hand in sort of, you know, building that, that really, the retail culture, retail investing in equities in a big way. Ankur, of course, is Deputy CIO, Brookfield, and he oversees hundreds of billions of dollars in real estate assets, $300 billion. So it's like I don't intend this to be like a face-off, equities versus real estate, although I think I don't mind it. What I want to do here is essentially use Raamdeo ji's, you know, almost childlike curiosity to learn about new things. And let me ask him to ask Ankur questions. Why real estate should be, you know, financialization of real estate should be the next big wave here in India. Actually, I'll just set the context with a data point. In India, there are 4 listed REITs, one of the structures through which, you know, we can own commercial real estate. The total market value of REITs in India is about $12.5 billion. In the US, the value of listed REITs is about $1.5 trillion. Private REITs are far larger, I mean, 2x, 3x of that number. I mean, as they say, what happens in terms of innovation, financial sort of innovation in the US eventually happens here. The lead time has maybe gotten even shorter. So, Raamdeo, should we ask Ankur to sort of lay the pitch in that sense? Why does he think this is the next big thing?
So I've been trying to convince my good friend, somebody I look up to a lot, and my neighbor Raamdeo ji that you know, he has to convert a little bit, not a lot of his capital, but a little bit to the built environment. So today we are going to do it publicly. So good luck to me. Thank you very much, Prashant, for laying this out. I wasn't prepared for this grilling by the Warren Buffett of India, but now that I've signed up, let's do it. You know, Brookfield has its roots, you know, way back 100 years ago. We started in Canada. And there's a very famous saying in the parallel of ice hockey, look where the puck is going and not where the puck has been or is. The built environment is a bedrock of the economy. We all believe we are here today because we believe the Indian economy will double and triple in short order, certainly in the course of our careers. And laying it in the context of where India is, the commercial real estate sector globally is about $130 trillion. It's the largest investable asset class in the world. The market cap globally is roughly similar of equities. In India, that number is a fraction. The size of commercial real estate sector is a few $100 billion. Our market cap, still pale compared to the US, is few $1 trillion. So clearly, the man who's built the market cap of the country is here to grill me on this, but I could be wrong by a factor of 10 or 20, but I still think I'll win this argument here. So as the financialization of the economy happens, there are 2 parts to it. One is the builders, the developers. We all saw some of the launches happening in Mumbai every day. So one is that environment, and second is the conduits to be able to pool capital and create alpha in that space. So I think both are very interesting as far as you know, my role at Brookfield is concerned. And you know, we are all believers in India, and this is a great place to see this story play out. And certainly globally speaking as well, this has been the largest asset type, delivered fantastic alpha across cycles. And we are here to see this sector develop even further.
Raamdeo ji, how's that for a first pitch? How's that for the first pitch? How's that pitch?
Yeah, that's great. Actually, the thing to ask is why, I mean, what it takes in an economy to develop this real asset market. Why it is fraction of it. I mean, 100 billion in a $5 trillion. So it's just about 2%, whereas at other places it is 50, 60, 70%. What it takes, I mean, it's not the mistake of anybody, but why it is not developed and what it will take for you and us and everybody, our government and policymakers, to make it actually big, or will it happen automatically?
Yeah. Look, this is the classic capital formation story. So one is the size of the economy is going to grow. And second is movement of capital will happen from savings, from bonds, from equities into real economy. We saw that play out at the turn of the century, around 2000s. A large part of large savings accounts or pension accounts, university endowments, were primarily 60-40 bonds and equities in the US. Those have moved towards 25% allocation today to alternatives. And a large part of alternatives is the real economy, infrastructure, real estate, power generation assets, etc. So Raamdeo ji, one is, we've seen that movie play out before where large pension schemes do need to allocate out of their savings accounts or bond accounts into economically vibrant sectors that still have the safety net and not fully exposed like equities could be, certainly in down cycles. So a typical real asset sector has inflation-like characteristics. So you get some benefit of growth and you get some benefit of dividends. And that is a good balancing factor between equities and debt, somewhere in the middle. That's called hybrids in India. So I think one is that part, which is the movement of capital. And second is we haven't seen economies go through a large middle-class formation without better office spaces, better roads, better airports, hotels, residences, etc. So second is just the movement of our middle class into more consumer segments. We've talked about how there is slowdown in FMCG in the country. When we were growing up through college, people talked about how India invented the 1 rupee sachet. There's only so much shampoo that an individual can use, and we have emerged from that aspirational India into the consuming India. So once the basics are set, now people will travel a lot more. People will go to good colleges. They like to stay in hotels. They like to be in better apartments. And frankly, they like to have conferences in places like this. This is the built environment that we're talking about. And this is the very, very early days of that.
I have one question. The case for developers is straightforward, right? I mean, they can recycle the asset, put it into a REIT structure, sell it to investors. So that case is very, very strong. I mean, then you get the capital back and you move on to the next project in that sense. From an investor's perspective, you briefly mentioned alpha. How do returns really compare? And I think over long periods of time, do we have evidence? How do they compare?
Yeah, so the returns for, let's say, Brookfield, and we've been doing it for 4 decades, our investment strategy in US dollar terms, just to equate because we invest globally, has generated about 18 to 19% compounded annualized returns investing in real assets over the last 3 decades or so, and in large volumes. So I don't think this compares any
18% compounded?
18% CAGR returns,
wow,
including dividends and capital appreciation returned back to our investors. So these are good numbers.
And when you say real, those are fantastic numbers. I mean, in India, Raamdeo ji, I think the 25-year CAGR in dollar terms in equities is what, 12%?
11-12%, yeah. So I think you are talking about your developer role as well as the REIT role, isn't it? All combined.
Yeah, and I'm just for context, our developer role is probably a small fraction of our asset management business, which is, yeah, we do build a lot, but as a fraction of our book, it's typically single digit in terms of percentages, which is the asset management side that you were talking about, Prashant.
That 18%, and you said real estate, real assets, it's largely real estate? Would it be, I mean, percentage-wise?
It's real estate, infrastructure, power generation assets.
And that 18%, I mean, for example, in the US, you've got things like distressed real estate, which are traded, and people have made humongous amounts of money, I mean, on the back of it. That 18% includes all of that as well? Or this is sort of, which is not available here, that is the point. I mean, if there is a distressed real estate, you've got 3 or 4 groups who sort of go in and then, it's not available widely for retail investors in that sense.
Look, I'll just set some context here a little bit, right? We're talking about a sector that's several tens of trillions of dollars. There are certain situations that come around where there is distress, where there's rescue capital, generally businesses are built on sound foundation. And one point that I did not make early on is real estate is a derivative economy, or real assets are derivative, which means that the larger economy is built on the real economy. I'll compare it to Microsoft. There can be 20 industries that use computers.
Ankur, if you can hold the mic a little closer.
And when any industry does well, they use more. Similarly, a large part of the real asset growth came from IT sector. Today it's coming from GCCs. It's also coming in from large Indian corporates. So the form of utilization of that environment changes. But the returns that come from a sound sector is not based on only distressed. So 18% is over 30 years. You've had cycles. You've had at least 7 cycles. So there has been distressed investing, there has been growth investing, and all forms of investing. The point I wanted to make was not to tom-tom about our performance. What I wanted to say was, as I said, where's the puck going? If fundamental economy is growing at 6-7%, you add 4 to 5% inflation, which is good inflation for Indian context, and you have lots and lots of businesses that will grow at massive rates. That's country average. A place like Mumbai, Bangalore, we've seen that play out in front of us. These cities will expand at even greater rate. And the underlying bedrock of that growth is a built environment or the real economy. And I think it wouldn't be surprising to us that we continue to generate such returns in places like India as we do in the rest of the world.
Raamdeo, what do real asset managers like Ankur and Brookfield and others need to do to really, tell the story more? Is that what is?
No, one of the things is that the public facing, we have 4 REITs, what you said, $11-12 billion. They, today, I think the yield offered is about 6-6.5%. And then on top of it, you have this resets of 3-4% or 5%. So that in all, it gives you about 11-12% pre-tax, which gives you about 9-10% post-tax. So that's what is available in public at large. But for the very large institutional investors, probably they might be able to become your prop investors at, say, GIC or all these people. They must be participating in your own balance sheet developmental role. So they might be getting that 18%. I don't think the public at large have access to 18% return.
Yeah, so it's a fantastic point, and it's a criticism that I would take, that we haven't had the longevity in the REIT space, REITs or InvIT space in the country to be able to demonstrate track record over a cycle. I'll give a data point. We invested in a large commercial portfolio in Mumbai, Powai. Annual rent resets 3-5% that you get. The underlying propensity or the earnings power of the same portfolio has increased 3x since we made our investment 9 years ago, which means you've gotten 8% yield and your capital values have increased by 3x over 9 years, which is, you make your math, 30% IRR. So you add the two, you're making 38% IRR in your business. And that is available to the REIT investors. It's just been 4 years that they've been invested in the REITs. They have to see a cycle play out, rents getting reset, next guys coming in, and so on and so forth. So these returns won't be made overnight. This is the real economy. But the good part is you're getting paid dividends while your underlying businesses are getting more valuable. And at various points in that cycle, you will see that either capital appreciation that will lead to income resets, which won't be 3-4%. If India continues to grow at 6-7% real, which is double-digit nominal, we can make our assessment as to what Mumbai and Bangalore will grow at, or Delhi and Gurgaon will grow at. And I would again reiterate the point that this will be very high returns.
Would you say that since there is a 18-20% capital appreciation, which will translate into higher yield as go for resets and change of the tenants or things like that? So are you saying that your REITs potentially on a 10-year basis can yield to me, if I buy today at 6.5% yield, upwards of 15-17%?
As we always have disclaimers, but I will be disappointed as an investor. And we are the largest investor into our REIT as Brookfield. So I will be very disappointed if our investment vehicles like our REITs and our funds don't do more than that, Raamdeo ji.
What was that number? 15%?
Yeah, I said that's what equity gives. So if it can beat with a collateral and kind of a downside protection, if it can give me 15%, clearly there could be a good arbitrage between equity markets and this. But what I understand is that it's a good mezzanine kind of stuff between the fixed income, that bank deposits, which is upwards of 200 lakh crores a year, and equity. So that's what I was thinking, but at 15-17%, it can actually challenge the equity market itself.
And we are the challengers.
But, you know, why it is not happening? I was speaking to my distribution guys. They say you guys don't market only.
Yeah, I think that's a criticism I'll take on my chin. Look, as I said, it's early days. A lot of institutional capital has found its way into the built environment. I think a question to be asked here is a little bit different. Let me ask you a question, Raamdeo ji, for a change. You know, we've got these fantastic developers in the country. We've got corporates creating assets like this. So that part of the business, people are doing as much as their balance sheet allows them to do. There will be distress, there will be aggression, there will be cycles, and no businesses are built unless you go through cycles, and leaders are forged in fire, as they say. But the other side of the equation is the liability management side. So you have asset creators, and we are in the liability management business. It's called asset management for a reason, but we are really managing people's liabilities or equity. So the part that needs to be solved is not whether REITs can deliver the market penetration that we think we should deliver to the retail investors. It's who are the conduits to deliver that. What is the conduit for us to get Indian pension money, Indian insurance money, Indian savings accounts into the equity-like returns that the built environment promises to relay back to people's savings accounts ultimately. And I think that is where the question to be asked is the other side, which is more asset managers, more wealth managers, more aggregators, emergence of domestic LPs, and a lot more global capital formation happening through either global asset managers like us or homegrown asset managers like what you have built, Raamdeo ji, in this country.
We have done for equities. You have done it for real assets or REITs, you are doing it. But I think the real thing is that even at 9-10% kind of a yield, effective yield to the clients, there is a tremendous market to be built in the fixed income segment of it. If it is 60-40, at least 40 is available to you for a take. And there I think, I don't know how exactly, you guys are manufacturers, you guys are marketeers. So how you want to position with the customers and the distributors. So first you have to, like in mutual funds sahi hai. So they have done tremendous job, and today it has taken the whole country by storm. And it has completely changed the capital markets, the risk capital flow. There's so much happening in stock exchanges and things like that, just going through the roof. So REIT sahi hai, or something like that, has to come through so that people can understand that they don't have to give 3%. I mean, I think HDFC gives less than 3% on fixed deposit. So against that, and they're not collateralized. Actually, yours is collateralized. And yet you give 10%. So there is a massive arbitrage between 9-10% post-tax.
Do we hear a converted here? Because if he's a convert, then I think most of my job is done today.
No, but you have to do marketing. Yeah.
But REIT sahi hai. So Raamdeo ji said REIT sahi hai.
Something. It can't be REIT sahi hai, but something like that.
Too much of direct competition in that sense. Ankur, just one thing. I have two questions actually. In the US, I mean, that point about retail investors, what Raamdeo ji said earlier. In the US, is it all, I mean, ownership of these assets is pension, etc., pension money, institutional money? Here, because in India also that's going to happen as the share of organized workforce increases. I mean, pension assets, etc., will grow, and they will look for these kind of better risk-adjusted products, right? So that'll happen. Go on.
Yeah, so Prashant, it's entire ecosystem, right? There's no one organization that can penetrate a population of 1.4 billion to begin with. US is 350 million people, and that's the financialization of the economy that's happened. You've got a lot of pension schemes, endowments, union money that's gotten pooled together, and then now there's talk about 401k accounts that will be allowed to invest in alternatives. So it's basically the movement of of savings accounts into better products to deliver the risk-adjusted returns. And I think that's what I mentioned. There are 4 pillars to this story, which is the asset managers, the wealth managers, the distributors, LP capital, and everything else. And I think that's likely going to happen. We are seeing that money flowing through mutual funds, through SIPs and other things. Our regulators will have to play their part in allowing a bigger playing field for hybrid instruments, as they are called. And I think it's a matter of time. We talk about trillions of dollars in the REIT space. In the US, for example, the first REITs in the US were railroad REITs. They weren't office REITs. It was followed by student accommodation, rental housing, then office came in. So it's a function of what part of economy is more stable, that always finds first takers, and then slowly the risk spectrum changes, and so do the returns.
And typically, one would imagine the best time to buy these, again, timing makes a difference. So when interest rates are high, yields are high, that's the time to buy, these products?
Again, that's one of the things that we've been trying to coach the market, and clearly Raamdeo ji feels we haven't done enough. When interest rates are high, your yields are higher, but typically they point to a market where something will happen, where either the markets are getting hot, or asset values are getting slightly ahead of the fundamentals. So any good economy functions very well in a good interest rate environment and a good inflationary environment. Like India is a growth market, we always should have good inflation. So yes, on the yield criteria, there's always a reverse correlation. But in the total return world that we operate in, these things are cyclical. They don't matter, ultimately.
Raamdeo ji, convinced, a little bit convinced on the opportunity?
Very convinced. In fact, one of his colleagues, he had visited me, and we were talking about it, and we all agreed that it could be $1 trillion opportunity only for Brookfield. And he is going to be the boss for that. So
there's only one boss on this stage, and that's the one who's speaking.
Raamdeo ji, but in terms of returns, right? You think it'll be something, because as Ankur said, it's going to take some time, right? We will have to see a cycle of these products listed, performing like we have in the US.
See, Prashant, if you see the advent of mutual fund in India, I think they started getting licensed sometime in 90s, 94, 95 and all. Till about 2003, there was nothing. And I know Madhu is here. He joined Reliance Capital with less than 1,000 crores. And in 5-6 years' time, he saw to it that it is 1 lakh crore. So that kind of explosion is possible. So it's just a tipping point. They need to do something, because the fixed income interest rates, particularly the fixed deposits, they are really going down. And that is pre-tax. So at 3-4%, if you have pre-tax, and these guys, if they give post-tax 9-10%, there is obviously a massive market waiting to happen. But somebody has to make it happen, So, and maybe if the return actually goes to 12-13%, then the market itself will just pull it off, So there could be a tailwind, massive tailwind about to be built, but time is the only issue. Yeah.
Just as we wrap up, Ankur, according to you, where are we? If what has happened in the US in terms of the size, scale, this growth of this industry, where are we? You said very, very, very nascent stage. Just about getting started. You think it'll pick up pace? SEBI, for example, has introduced new products as well. I think there is a small REIT. I think 1 or 2 assets in that REIT under 500 crores. So that regulatory push, etc., is there.
Yeah, look, from my perspective, the low-hanging fruit is plentiful in this space, which is we don't have to go very creative. The other day I read about seniors living in the country being a very interesting sector. India is supposed to be a very young country, but we'll also probably have a very large older population, which will need assisted living, seniors housing, etc. So the point I'm trying to make here is that we have to do the basics right. For me, co-living is a verb, not a noun. Co-working is also a verb, not a noun, which means that all these are offshoots of the fundamental economy. We need the built environment to grow bigger. During COVID, people talked about the death of the office, that people will never work in office again. That might be true for suburban America, in India, we have shortage of office. We need hundreds of millions of square foot of office to be built just to take care of a fraction of the number of college graduates that we have every year. So we don't have to look west to find solutions. We have to look inwards. We have to look at what works for us, which means that, yes, there will be SM REITs, but that's small. We're talking about $50 to $100 billion of investment required in just the office space in India. You add hotels, you add warehouses, you have toll roads, you add telecom towers. We're talking about hundreds of billions of dollars of capital required in the core sectors right now.
I think we can sort of, on that note, that I think both of you agree, Raamdeo ji and Ankur, that maybe we are at the beginning, as Raamdeo ji said. Ankur and others need to tell the story as well, right? Explain to people, as I think Ankur has tried to do for all of us here in this audience. Thank you very much for joining us, Ankur and Raamdeo ji, for taking our audience through this very interesting discussion. Reimagined, can real assets outpace equities? Thanks very much once again.